Welcome to episode 55 of The 5-Minute Investor, the podcast where we break down stocks at the heart of two stories shaping your investing week. I'm Trevor Abbas.
And I'm Jonathan Brown. Each week we bring one stock, one headline, and one reason investors should care.
This week, with oil surpassing $110 per barrel, we're profiling a pair of stocks with the potential to help you hedge your portfolio against energy market volatility.
That's why we're talking about Cenovus Energy Inc. today, CVE on the Toronto Stock Exchange and New York Stock Exchange. This Calgary-based oil and gas stock offers what we call maximum torque to $100 oil, since it is one of the most oil price-sensitive large caps in Canada. When oil prices skyrocket, Cenovus's position doesn't just improve, you can see its free cash flow explode.
So betting on oil when oil is high, John, this sounds like the same logic as buying an air conditioner in December.
Yeah, it's a similar strategy. It works thanks to Cenovus's clean balance sheet, though, which equals equity torque. Since the acquisition of Husky Energy in 2020-2021, Cenovus has paid down debt aggressively, simplified its asset base, and shifted into a capital return mode. At $100 oil, the market stops glazing CV stock like a rehab story and starts valuing it like a return of capital machine. Dividends plus buybacks get very real, very fast.
The strategy seems like it was made for the U.S.'s current insular agenda when it comes to energy, no?
Yeah, this integrated model has also lowered a lot of the downside risk. Because Cenovus owns long-life oil sands production as well as upgrading and refining capacity in Canada and the U.S., so that just means it benefits from higher crude prices and also buffers itself if differentials blow out. For a hedge discussion, that's gold, and it isn't a YOLO bet or anything that on spot oil. It's structurally advantaged to operator if crude stays high.
Okay, so what about the stock performance?
Well, the stock has risen more than 100% since this time last year. Back in February, Cenovus announced its fourth quarter and full year 2025 results, and I found some good news in there. A 5% increase in upstream production of 918,000 barrels of oil a day in Q4. Revenue took a dip, both for the full year and quarter, and that was due to lower benchmark oil prices.
Okay, but lower oil prices aren't really an issue today, so that will be something to track for their future updates.
Yeah, Cenovus is a stock that pays dividends because oil is expensive. But what about another stock that exists because things break when oil is expensive? This is a two-axis hedge episode, and on the other side of that coin, Trevor has a different story than a safe dividend-paying incumbent.
I do indeed, John. To amp up our listeners' hedging power, my suggestion this week is junior miner Thunder Gold, ticker TGOL on the Venture Exchange, whose micro capitalization and large flagship project make an enticing case for undervaluation.
So let's lay out your thesis for us here. With the push and pull of the oil market volatility, how might investors in Thunder Gold end up ahead?
Well, on the one hand, oil prices remain at about a 10-year high at over $100 per barrel, flushing producers with cash, while inflating the prices of innumerable products in our everyday lives that depend on fossil fuels to be transported and produced. On the other hand, we have gold, which has proven itself capable of appreciating with inflation, as well as alleviating higher expenses for those that own it.
Yeah, why not just own physical gold? I love it. I love to hold it. Why bother with a gold stock that I can't hold?
The answer to your question, John, really depends on temperament. While physical gold will likely serve investors well in the currently tumultuous energy market environment, the metal will fall short of the leverage gold explorers, developers, and producers are capable of achieving. We see this potential in Thunder Gold, whose Tower Mountain project in Ontario is estimated to host more than 3.5 million ounces in gold resources, representing more than $16 billion US in the ground. This equates to more than 650 times the company's current market capitalization, currently standing at $33.71 million, making for a blaringly green light for investors to verify potential undervaluation.
And just how has Thunder Gold stock matched up to its underlying company's monumental promise?
Investors have responded positively to the company's steady stream of exploration results over the past year, lifting the stock by about 83% over that time period, comfortably beyond gold's 54% effort. And with drilling at Tower Mountain ongoing to expand and better define the known resource, with a new resource estimate planned for Q4 2026, investors are positioned to benefit from further catalysts for shareholder value as fresh news crosses the wire.
Playing devil's advocate here, I'm wondering what the consensus is on high gold prices, which have been soaring over the past few years, to support Thunder Gold's value proposition as it ushers Tower Mountain along the mining life cycle.
Well, the best we can do here really is offer forecasts, of course, and those should always be taken with a grain of salt. That said, there are a number of well-respected institutions that see further upside from the current $4,600 per ounce price. CIBC, for one, sees a path to $6,500 gold by 2027. BMO is even more optimistic, envisioning gold at $8,650 per ounce by Q4 27 in its most bullish scenario. So while there's never a guarantee in investing, the near-term future, at least for gold, has a noticeable glimmer to it.
As always, you can find links to the articles from today's episode in the show notes and more investing insights on stockhouse.com.
And you can find the 5-Minute Investor on Spotify, YouTube, iHeartRadio, Podbean, Stockhouse, or wherever finer podcasts are found. This podcast is produced in partnership with Cenovus Energy and Thunder Gold and is intended for informational purposes only. For full disclaimer information, please visit stockhouse.com/legal/disclaimer.